Welcome to Trading Lounge and the SP 500 for the 16th of August, Asian time. And this particular pattern that we're looking at here is obviously corrective, but there's, well, I can see two different ways of counting it. One of them is like this here, and in this case here we would be looking for a move back here. We would look at, well, let's just put some of these over here. We'll just have a look at two different ways that this can play out, and then we will look at strategies for those. So in this case here we can look at an A wave, a B wave, and 5 waves down as a C wave here. 3, 4 and 5, something of this nature here. So this 50-60% retracement level here is important, and that comes in close to the 2900 area here. So that's one way to look at it. The other way to look at it is that this particular structure here as wave B is not complete yet, so wave B can be moved over here. And I'll just remove these here for a moment. The B wave can be here. This would be an A, B and C here, but the reason I haven't put this as a C wave here is because I haven't got 5 waves in it. There's only 3 waves, so I had it that way. So in this case here we would look for a move higher here. So I'd like to consider it coming back to the 61.8% retracement level area here, and then move down from that point. So the difference in a nutshell here is that, well, there's 2 points. One of them can come to here and drop, and the other one can come to here and drop. The one to here would be in 3 waves and then dropping. This one to this point up here would be a C wave, so it would be, move that over to here, so an A wave, a B wave here, and of course this C wave. I better do it all properly. So like that, and in this case here, then from this current low here, if I could just remove that. From this low here, we'd be looking up as 1 and 2 and 3 and 4 and 5 here, and then coming down this way here. So they're the two possibilities we've got. And of course, well, if the market just dropped below here, then that would be trigger a short trade here for sure. But the problem here is that we've got 5 waves down here, so we have to see some type of, some type of move, counter trend back up before seeing a move down. But all the same, if that low got taken out, you'd want to be short there if I was wrong, because sometimes in bear markets they can just cascade and catch you out and you miss them. So you've always got to be thinking outside the box. You need to put whatever can possibly happen, put it on the table and come up with a strategy for those, and then take those trades as they get triggered. But don't overtrade, because if you overtrade all the time, not only will you lose your account, but you'll end up being fearful of putting trades on as well. So anyway, let's go in. So they're the two things that can happen at this particular point. Yeah. So on the hourly chart here, we can count 5 waves down here. I'll just count them with these guys here. This will be fine. But the question now, though, is that do we call this wave 1 and 2 here, and then 3, 4 and 5? I think it'll only come to the top here. It'll struggle there anyway. Or the other side of the coin for this here is just going an ABC pattern, which has already started, so I'll just put that up there. So an A wave up here, and we'll look at this structure in a bit more detail in a moment, and wave C coming into this box here. It's all about the 2900 here. This is it's all about this level here, and the 61.8% retracement level and the 2900 come into the same thing there. So I guess one way of looking at this too is that if we consider this wave 2 here and wave 3 comes up to the 2900 area through here, then the wave 4 here would pull back. Oops, I should do it over here. Wave 4 would pull back to the 38.2% retracement level and then move up into this space here. And then if the market comes down here, it would bounce off here, then it would come through here, and then it would push back up, and then this becomes the catalyst for the short trade at that point. So that's one way to look at it. The other point here too is that, as I mentioned, with this one here, this move up here, move that roughly there, because the A wave and the C wave will have some sort of equality to them. So it may not come all the way up to the 2900 area here. So just be mindful of that. So we could say that with wave 4 here, if the market came up to wave 3 here and came back to wave 4, the 72 here would be the support for that. So we could say here too, if we move this here, in this case, so this is group 2 here, so 65, 72 and 80 normally would and you can do this too, but if 72 became the retested resistance, you could look to short. But if you wanted to be a bit safer, then wait for this pattern here to occur at the 65, and then that will get you going on that side. And you can also use the 50 here as well, the midpoint here. So if that becomes the retested resistance, also look to add that short trade in there as well. So I'll just pop that back up there. In fact, that should really be on an angle, because this just to get a bit closer here, this retest here will also be it'll be in 3 waves, but it will also be on lower volume as well. So if you look at this move coming down through here and look at the volume on that move, and you might have to go to a larger time frame to see try and get the volume, all all those bars in one volume bar, or 2 volume bars, or 3 volume bars. And then this one here, this will be on lower volume here, and that lower volume moving back up here, that's divergence, and that's where you'll see those in all the indicators. So you don't need the indicators, you just need to look at the volume. If that's going back up, retesting on lower volume, then all your indicators will be showing divergence there, so you don't need the indicators to do that job. Once you know the calculations of every indicator, then you'll see it in the price and you won't need them. So that's cool, that's cool, that's cool. Yeah. So yeah, so that's it really. Let's just have a look at, if you want to go long now, let's just look at that on the tick chart, because we'll just need a bit more detail in there. Okay, so this particular pattern here is a classic trading levels pattern. So if I bring that up here and show you that, so the classic trading levels pattern is the arrival, the reaction, the first high above the level, then the ABC pattern here, and then we want it to find support on here. So you can, normally we take this high here, this high here. These are these highs here. When these highs over here become the support, a tested support, then you can add to those positions. But it's this pattern here that we're looking for, where it migrates from being resistance to support. And there's an emotional event that goes on in here. I won't talk about that today, but it's worth looking at. And that's the pattern here. So the arrival, the reaction, the first high above the level, the corrective move here. So in a nutshell, this would be our that would be our entry here. That would be the safe entry here. Of course, you know, you can get in anywhere and do anything you want, as long as you know what you're doing. You know, that's the important point. So the next thing here would to be ask yourself, well, can I get in earlier here? Well, there's a couple of things that we could do here to look at, just to refine things a little bit. That's the midpoint, so the 5 is really important, and you have to ask yourself, is that support there yet? I mean, it's just a bit, because we're at the end of the session as well. It's 7:30 in Sydney at the moment, so it's the end of the US session, so it would be probably good just to allow this to settle. But if this is the midpoint here, which I'll just darken that line up a little bit, and then we can look at the micro levels here. So it would be 1, 2, and 3 here. Well, it's pretty high up there at the moment. So 2 here, 1 here. You can go, this is 100 ticks, so you could probably just go into 20 ticks at this particular point. And then you got the midpoint here, 5. So these are all places that you could add on here. So you can go long here, but you just need to wait. That first high is in play here, so we'll just copy this. So you need a breach of that particular high, because that little move back down here is retesting the 50 here. There might be more to it here. This looks like a 5-wave move up through here. So this would be an A wave, a B wave, and a C wave coming here. So that top would be okay, but this would be where you would scale in from at this point. And of course, coming back onto the hourly chart here, our target area for this would be if it's just going to be corrective as an A wave and a B wave and a C wave here, then the first thing that we need to look at is that this wave 1 here, or wave A here, wave A and C can have some sort of equality in them. So realistically, if you were trading up here, then the 72 here, the 28.72 would be the first target area here to take profit on. And if the 72 became the support, well, then you could move back in and trade it up a little bit higher. But yeah, trading between 5 and 8, but I always prefer the 72, that's the space to get it in. And if you wanted to take profit earlier, well, then the 65 would be where you'd take 50% and then take the rest of it at 72. And if 72 became the support, well, then you could get a smaller position back in and then go higher from that point. But yeah, I mean, we may end up way up here, and you've gotten out too early here, but you know, you've cut the cake and you eat it, and that's it, and you know, that's your lot. So no use crying over spilt milk. But anyway, without targets, trading stops are better than fixed stops, because trading stops will keep you in the market. And you know, when we consider how many times we're wrong with things and we've gotten out too early, then the trading stop is really the way to go. Alrighty, thanks for tuning in. Cheers.